Okay, let's dive into this because honestly, the sheer scale of the money flowing through Wall Street every single day, it's absolutely mind-boggling. Welcome to this explainer. Today, we're going to completely pull back the curtain and find out exactly how modern investment banks actually generate their massive fortunes. We're stripping away the rumors, the Hollywood stereotypes, and all that confusing financial jargon, and we're just looking at the hard data. If you've ever wondered how these financial titans truly operate behind closed doors, well, you're in the right place. Just let that number sink in for a second. $53 billion. That was Goldman Sachs' total revenue in 2024 alone. I mean, that is just a staggering amount of money. But you know what really surprised me? And this totally shifts how you need to look at this whole industry. Most people just assume that money comes from, high-stakes, super aggressive stock trading. But it doesn't. Actually, less than half of it came from trading. The biggest, steadiest, and honestly kind of most boring-sounding chunk of that $53 billion came from stuff like advising on corporate mergers and just managing the wealth of really rich people. And that one single fact, it explains almost everything about how investment banks actually make their money. You see, we've all been sold a very specific image of Wall Street, right? Like if you picture an investment bank as this chaotic room full of guys in sharp suits screaming buy, buy, buy while staring frantically at these flashing red and green screens, well, that's the Hollywood version. And sure, it makes for incredible cinema in movies like The Wolf of Wall Street or The Big Short. Those are really fun stories, but they paint a highly misleading picture of what's going on today. The reality of modern banking is way less about wild gambling and much, much more about structured advising, managing long-term wealth, and facilitating trades strictly on behalf of their massive clients. So here's our roadmap for today's explainer. First, we'll cover the Hollywood myth, then the four money engines. After that, a perspective on fees, followed by the unbreakable moat, and finally, real differences. All right, section 1, the Hollywood myth. Let's start by busting some of those major banking myths. So the truth is, investment banks barely trade with their own money anymore. Why? Well, it goes back to the 2008 financial crisis. Following that whole global meltdown, regulators cracked down incredibly hard on banks making massive, speculative bets with their own balance sheets. In the US, this crackdown took the form of something called the Volcker Rule. And because of these strict regulations, today, when an investment bank executes a trade, it's almost always acting as a middleman. They're trading on behalf of a client, like a giant pension fund, a global corporation, or an asset manager. They are simply not betting their own cash on where the stock market is going to go next. Let's move to and see how this builds in part 2, the four money engines. If they aren't gambling, let's see how banks actually earn their money. These are the four core pillars of modern banking. Each one operates with a totally different business model, different risks, and unique fee structures. We've got M&A advisory, underwriting, market making, and asset and wealth management. Let's start with engine number 1, M&A advisory. This is your classic, quintessential investment banker job. When one massive company decides to buy another company, they don't just, figure it out on a napkin. They hire an investment bank to manage the entire process. We're talking valuing the target company, negotiating all those cutthroat terms, structuring the deal so they avoid any tax or legal disasters, and basically holding the client's hand through months of pure tension. Now, here's what always surprises people. The fee is not a flat rate. It's actually a percentage of the deal size. And get this, that percentage shrinks as the deal gets bigger. So for a relatively small deal, say under $10 million, an advisor might charge 5 to 10%. But for a billion-dollar mega deal, that drops to roughly 0.5% to 1.5%. But hey, don't let that tiny percentage fool you. 1% of $1 billion is literally $10 million for just a few months of work. And this is a total winner-keeps-winning business. Once a bank successfully advises on a major deal, they're the ones getting the call for the next one. That's exactly why Goldman Sachs ranked number 1 globally in announced and completed mergers and acquisitions in 2025. It's decades of trust built one high-stakes deal at a time. Okay, moving on to engine number 2, underwriting. This kicks in when a company needs to raise a ton of cash, either by selling stock to the public for the first time in an IPO or by issuing bonds. And here's what I found completely fascinating. When a company goes public, the bank doesn't just act as some glorified salesperson. No, the bank actually buys the shares from the company first at a deeply negotiated, agreed-upon price. Then, they turn right around and resell those shares to investors. If the hype is real and the resale goes well, boom, the bank profits off the spread. But if it goes poorly, the bank can actually get stuck holding millions of shares that nobody wants. That is real heavy risk sitting directly on the bank's own balance sheet. For taking on that massive risk, banks typically earn a fee of 3 to 7% of the total amount raised for an IPO, and usually under 2% for bonds, since bonds are generally considered much safer. And this brilliantly illustrates the sheer scale of the risk and reward here. Just look at the historic SpaceX IPO that happened on June 12, 2026. SpaceX went public on the NASDAQ at $135 a share, raising around $75 billion. Let me repeat that, $75 billion. It was literally the largest IPO in history, valuing the whole company at roughly $1.75 trillion. You do not just trust a deal like that to some random broker. 10 massive banks shared the underwriting job, led by Goldman Sachs and Morgan Stanley, with heavyweights like JP Morgan, Citigroup, Barclays, and UBS rounding out the syndicate. The fees generated from that single event are just astronomical, but remember, they are directly tied to the massive risk those banks absorbed by underwriting it. Which brings us to engine number 3, trading and market making. Now, we already established earlier that they aren't placing wild bets on the market. Instead, they act as market mokers. The easiest way to grasp this is to think of a currency exchange booth at an international airport. The booth operator isn't sitting there trying to predict if the euro is going to rise against the dollar tomorrow. They don't care. They're just always ready to buy or sell, profiting from the tiny little gap, the spread, between the buying price and the selling price. Well, investment banks do exactly this, but repeat it hundreds of thousands of times every single day. If a massive pension fund needs to offload $500 million of stock without completely crashing the market price, they call a bank. The bank's trading desk absorbs it, profiting from that tiny spread. So it's a business of incredibly small margins, but enormous, mind-bending scale. To give you an idea, at Goldman Sachs, the division covering trading, market making, and investment banking fees combined generated almost $35 billion in 2024 alone. And finally, engine number 4, asset and wealth management. This is definitely the least flashy division, but you know what? It's arguably the smartest business model of the whole bunch. Why? Because the revenue is recurring. When a bank manages money for ultra-wealthy individuals or massive institutions, it typically charges an annual fee, usually somewhere between 0.5% to 1% of the total assets. And the kicker? They charge this every single year, regardless of whether the stock market shoots up or crashes down. Think about it. M&A fees and IPOs are one-time, incredibly exhausting events. You close the deal, you get paid, and then you have to go hunt for the next one. But wealth management fees? They just keep showing up year after year, exactly like a really, really expensive subscription service. Goldman's asset and wealth management division alone brought in over $16 billion in 2024, managing assets that had grown to over $3 trillion. Trillion with a T. All right, to help make sense of all these crazy abstract numbers, let's move to part 3, perspective on fees. Let's put these billions into context. Imagine a company gets acquired for $10 billion. The advising bank on that deal might charge a fee of around 0.75%. Now that amounts to a $75 million fee for one single transaction, which is usually all wrapped up within 6 to 12 months. Now compare that to the median annual salary in the United States, which sits right around $60,000. That single deal fee equals more than 1,200 years of an average American salary. And that $75 million, it's earned by a relatively small team of maybe 20 to 40 bankers. This staggering math is exactly why outsiders naturally just assume bankers are grossly overpaid for doing, a bit of financial paperwork. So if the fees are so incredibly high, why hasn't some tech startup come along and disrupted them? That brings us perfectly to part 4, the unbreakable moat, and exactly why disruptors fail. So the crucial point is that you can't just download these 4 pillars from an app store. First off, relationships. CEOs and CFOs don't just go on Google and search who can handle my $10 billion merger. No, they call the banker who has known their company intimately for 15 years. Second is distribution. If you need to sell $2 billion of new stock by Tuesday, you need direct, speed-dial access to thousands of institutional investors who are ready to write massive checks. The big banks already have that network. Third, balance sheet. Like we saw with underwriting, you need tens of billions of dollars in pure capital just sitting around, ready to absorb sudden market risk. You literally can't fake that. And fourth, trust. When a company makes the absolute biggest financial decision in its entire history, they want a bulletproof track record of flawless confidentiality. One single leak to the press can destroy a multi-billion-dollar deal overnight. Put those 4 things together, and you get an industry that is virtually impossible to undercut. Finally, let's jump into part 5, real differences. It's time to clear up the confusion about who actually does what in the financial world. Now, what's really interesting about this slide is how cleanly we can separate 3 very different businesses that the media constantly lumps together. First, a commercial bank. That's just the branch down the street. They take your deposits, pay you a tiny bit of interest, and lend that money out as everyday mortgages and car loans. Think of the retail side of Bank of America. It's your boring, everyday banking. Then you have a hedge fund. This is a private investment firm that takes money from the ultra-wealthy and actively tries to generate massive returns by aggressively betting on the markets. They are the ones actually taking the big directional risks. They're the gamblers. And finally, the investment bank. As we've explored today, their core business isn't retail lending or market gambling. It is strictly facilitating deals, underwriting fundraising, and making markets flow for massive clients. Think Goldman Sachs or Morgan Stanley. The reason this gets so confusing for the general public is that mega institutions like JP Morgan actually blend a commercial bank and an investment bank under one single roof, which completely blurs the lines of what the company actually does.
So as we wrap up this explainer, I really want to leave you with this final thought. The next time you see headlines out there criticizing Wall Street banks for reckless gambling and betting against the economy, ask yourself, are they actually describing modern, highly regulated deal facilitators like Goldman Sachs? Or are they mistakenly describing the behavior of a private hedge fund, or maybe even a pre-2008 ghost of a trading desk that simply doesn't exist anymore? The reality of how investment banks make their billions isn't found in some wild casino bet. It's found in the quiet, structural plumbing of the global economy. And honestly, the fact that they make so much money acting simply as the plumber is perhaps the most fascinating detail of all. Thanks for watching, and I'll catch you in the next one.